Most people believe there is a simple rule in life that never changes. If you print too much money, everything falls apart. Prices explode, savings are wiped out, and chaos follows. History books warn us about it, parents repeat it, and economists seem to agree. Yet here we are, watching governments create trillions of dollars with a few keystrokes, and daily life keeps moving. Stores are open, salaries are paid, and the system looks stable. So the uncomfortable question is this: what if money printing does not hurt right away? And what if the real consequences are hidden somewhere else? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand how governments print money without immediate consequences, we need to go back to where modern money actually began. For most of human history, money was something physical and scarce, like gold or silver. You could not create it easily, and governments were limited by what they could collect or mine. This changed dramatically in the 20th century when paper money replaced metal coins, and later when paper itself became optional. Money slowly turned into trust, backed not by gold, but by governments and their promises. One of the biggest turning points happened during major wars. Wars are expensive, and taxes alone could not pay for them. Governments borrowed heavily and central banks stepped in to help. In the United States, the Federal Reserve was created in 1913, partly to stabilize the financial system and partly to give the government more flexibility. During World War I and World War II, massive amounts of money were created, and surprisingly, society did not collapse. This planted a dangerous but powerful idea: maybe money printing could be managed. After World War II, the world entered a new financial order. Other countries tied their currencies to the dollar, and the dollar was tied to gold. For a while, this worked well. By the late 1960s, the US was spending heavily on social programs and the Vietnam War. Dollars were flooding the global system, and foreign governments started to question whether the US really had enough gold to back them. In 1971, President Nixon made a shocking announcement: the US would stop converting dollars into gold. This single decision quietly ended the gold standard and changed money forever. From that moment on, money became purely fiat, meaning it existed because governments said it did. This is where the story gets interesting. Once money was no longer tied to gold, governments and central banks gained incredible power. They could create money to respond to recessions, financial crises, and emergencies. Every time they did this, the immediate pain seemed smaller than expected. Fast forward to the financial crisis of 2008. Banks were collapsing, markets were panicking, and the global economy was on the edge. Central banks responded with a new tool called quantitative easing. Trillions of dollars appeared almost overnight. Many people expected hyperinflation, but it did not happen, at least not right away. If trillions could be printed with no immediate disaster, why not print more? Governments learned that as long as inflation stayed low, they could keep borrowing and spending. Central banks argued that they were managing inflation carefully and that the money would circulate safely. The public, seeing stable prices, mostly accepted this explanation. But something important was happening quietly in the background. Instead, it entered through banks, financial markets, and large institutions first. This is known as the Cantillon effect, and it explains a lot. Those closest to the money source benefit early, while everyone else feels the effects later, usually in the form of higher prices. Imagine a simple example. If new money enters the economy through banks, banks lend more. Asset prices like stocks and real estate rise first. Investors and homeowners see their wealth grow. Wages, however, do not rise as quickly. By the time the average worker feels the impact, the cost of housing, healthcare, and education has already increased. On paper, inflation looks low, but real life feels more expensive. This helps explain why governments can print money without obvious consequences, at least for a while. These effects are slower and less visible, which makes them politically convenient. But just because something is hidden does not mean it is harmless. Governments borrow more, knowing central banks can keep interest rates low. This cycle feeds itself. As long as confidence remains high and interest rates stay manageable, the system keeps running. The danger is not in the printing itself, but in the loss of trust. A real breaking point comes when people stop believing the currency will hold its value. History offers many examples, from Weimar Germany to Zimbabwe. In those cases, money printing was extreme and uncontrolled. Today's systems are more sophisticated, but the principle is the same. Confidence is everything. As long as people trust the system, money works. When that trust breaks, consequences arrive fast. The pandemic in 2020 pushed this system to its limits. Governments shut down economies and responded by printing money on an unprecedented scale. Stimulus checks, business loans, and emergency spending flooded the system. Again, many expected immediate inflation, but it took time. When inflation finally appeared, it surprised people who thought money printing was harmless. By 2021 and 2022, prices began rising sharply. Central banks called it temporary at first, then they changed their tone. Interest rates were raised aggressively to control inflation. This revealed another hidden cost of money printing. Once inflation escapes, fixing it becomes painful. Higher rates hurt borrowers, slow growth, and expose weaknesses built during years of easy money. Here is the twist most people miss. Governments did not print money because they wanted to be reckless. They did it because the alternative looked worse. Allowing large banks to fail or letting unemployment explode would have caused immediate political and social chaos. Money printing delayed the pain, spreading it over time instead of concentrating it in one moment. This is why money printing often feels consequence-free. The costs are delayed, indirect, and unevenly distributed. Savers lose purchasing power slowly. Young people struggle with higher asset prices. Governments roll over debt instead of paying it down. Each group feels a small part of the problem, but no single moment triggers outrage. Modern monetary theory, or MMT, takes this idea even further. It argues that governments that control their own currency cannot run out of money, only out of real resources. According to this view, money printing is not the real problem, inflation is. As long as inflation is controlled, governments can spend freely. Critics argue this underestimates political pressure and human behavior. What makes today different from the past is scale and speed. Money can now be created digitally in seconds. Financial markets react instantly, news spreads globally. This means mistakes can grow faster than ever before. At the same time, governments are more interconnected, making global consequences harder to predict. Another hidden effect is moral hazard. When markets believe central banks will always step in, risk-taking increases. Investors assume bailouts will come, so they push boundaries. This inflates bubbles and makes crashes more severe when they happen. The system becomes dependent on intervention, like a patient relying on constant medication. You might wonder who really benefits from this system. The answer is uncomfortable. Those with access to assets, credit, and financial knowledge benefit the most. Those relying on fixed incomes and savings suffer quietly. This is not always intentional, but it is real. Money printing reshapes society in subtle ways. Despite all this, governments keep printing money because stopping is difficult. Reducing debt requires spending cuts or higher taxes, both politically unpopular. Letting markets fail risks social unrest. Printing money is the path of least resistance, at least in the short term. The question is how long that short term can last. History suggests that systems like this do not end quietly. They either reform gradually or break suddenly. Gradual reform requires discipline, transparency, and trust, which are hard to maintain. Sudden breaks happen when confidence disappears overnight. No one knows exactly when or how this system will change, so where does that leave us today? We live in a world where money is flexible, powerful, and dangerous. It can stabilize economies or distort them. It can protect jobs or inflate bubbles. Understanding this does not require complex math, just awareness of cause and effect. The first takeaway is that money printing is not free. The costs are real, but delayed and uneven. The second takeaway is that trust is the foundation of modern money. Once trust weakens, consequences accelerate. The third takeaway is that individuals who understand the system can make better decisions, even if they cannot control policy. The warning is simple: systems built on confidence can change faster than anyone expects, and staying informed is no longer optional. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.